That's correct.
So it's up to me to handle the closing of this conference. It has been a long day, but I hope that all those who have attended found it also a fruitful one. As we reach the end of this conference, I would like to spend the next 15 minutes to highlight some takeaways that can be drawn from the remarkable group of speakers that we had today. But just before moving into the takeaways, there are also other very important words I must convey. First of all, a deep expression of gratitude to all the speakers for having shared with us their ideas, their analysis, their thoughts, including and especially the provocative ones. Apart from the interesting and stimulating discussions throughout the day, the contents of the presentations also provide us substantial insights and food for thought that will last beyond this conference. The gratitude is also extended to my colleagues from the board of the Banco de Portugal and also from the Financial Stability Department, who have chaired the conference sessions. I would also like to thank all who attended this conference, not just from Portugal, but from many different countries around the world. According to the last number I was given, and I'm glad I don't have to say this number in German, there were 555 registered participants. And one last and very deserved word of appreciation for the team that made this event possible. For the sake of time, I will only mention a few names: Anabela Marques, Rita Correia, Katia Neubauer, Ana Pereira, Tiago Pinheiro, Nuno Ribeiro. But through them, I would like all other that I could not mention, but also to feel included. Again, to all, a big and very wholeheartedly felt thank you. Moving now into the takeaways of this conference. In the first panel, which was focused on policy responses during Black Swan events, we learned the importance of the policies which have been implemented in response to the sanitary crisis by fiscal, monetary, and prudential authorities, with the purpose of such policies being to support the liquidity and the solvency of families, of firms, and banks. It's beyond dispute that the policy response was broad, was swift, was coordinated, and also effective. And because of that response, we've avoided, at least until now, a deep and long economic crisis, which looked the most likely scenario at the beginning of the pandemic. Against this background, one thing that must be avoided is being complacent about the policy response. And to ensure we avoid such complacency, there are many questions we should not just raise, but also try to answer. Have we done enough? Could we have done more? Should there be other crises? Will different policymakers respond so swiftly and effectively as they did to this one? Will they coordinate their actions? And I mean, the list of questions could continue. It is important to keep in mind that there are many ways in which this sanitary crisis is unique. And there is one in particular which is very important. I'm essentially referring to the fact that this crisis has had very favorable conditions for public intervention. It is a rare event. It came from the outside the financial and economic system. It affects everyone. There are no economic or financial villains, at least for now. There is support for public intervention, and moral hazard is barely a concern. So we should then be asking ourselves, was this swift and effective policy response we observed the outcome of the type of the crisis we are facing, or was it the result from the lessons that we learned in past crises? And the point I'm trying to raise is that we have to make sure that we have in place the institutions and the legal framework that would promote a similarly broad and coordinated policy response for other types of crises, should they ever occur in the future. And we all know that it is not a question of if, but if they happen, but rather when will they happen. Talking now about the second session, the focus was about the new challenges and risks for financial stability in the aftermath of the crisis. Here too, I think we can extract very important takeaways. We might have already left behind the worst of the crisis, but that doesn't mean it is over. The economy in general and some sectors in particular, they have been on life support. And as we move with the phasing out of this support, some firms and households, they are more than ready to live without it, but others either will not survive at all, or in order to survive, they will still need additional support. This means that banks, they are likely to experience higher credit losses going forward, which requires not just keeping an eye, but I would say both eyes, and probably it would make sense also to have the nose on these losses. In addition, we need to be ready to act before they become detrimental to financial intermediation and stability. And although bankruptcies, and I hope I'm not taken wrongly here, but although bankruptcies are a normal and necessary component on every functional and prosper economy, they become very detrimental when viable firms are the ones going bankrupt. So as support measures are phased out, it is important to promote the solvency of viable firms before undesirable bankruptcies materialize. This implies that a fundamental pillar to the success of any program aimed at supporting firms is, or particularly their solvency, is that it is capable of identifying the viable ones, which is notoriously a difficult task, but clearly banks, they have the key role to play here, given their experience in assessing firms and the investments. Apart from the identification of viable firms, which is anything but trivial, the design of the program to support firm solvency is also critical. In particular, programs requiring co-investment of private agents and support through equity or quasi-equity instruments may be overly complex and costly to small and medium firms. So I don't want to spoil the sense of relief we have been experienced, but we have to keep in mind that we are addressing the topics through the lenses of a central bank. And a central bank, in order to comply with its mandate, in what regards the preservation of financial stability, has to be particularly aware of risks and vulnerabilities. And this means that as a central bank, we feel that the economic recovery is not something we can take as guaranteed. Potential future coronavirus mutations and supply bottlenecks, they could have the capacity to derail the economic recovery. This means we cannot disregard additional new challenges to financial stability, some of them which, if occur, can be accentuated by the pandemic crisis. Talking now about the third session, which was focused on technological transformation, this is an area where we've been adding new expressions to the financial world lexicon, probably in an unprecedented way. Fintechs, big techs, DeFi, cryptocurrencies, digital money, these are just a few examples, and these names, they reflect what can be described as an extraordinary technological transformation that is happening in financial intermediation. And I believe it's beyond dispute the idea that every business is an information business. And if that is beyond dispute in general terms, it is even more true in the banking sector, where IT and data are taking a central role, be it in the relation between customers and banks, or be it in the way back offices operate. And as usual, new technologies, they come with all debates of whether technology is a good or a bad thing. It's not difficult to identify many positive impacts that technology helps materialize, but as it happens with metal coins, there is also the flip side of it, which in the case of new technology are the new risks it brings. And among such risks, cyber risks ranks high, if not the highest. Should a successful attack to a large IT service provided to banks occur, it may quickly become an event of systemic nature. This is clearly an area where a lot of ground has to be covered in order to ensure that we have the capacity to assess this risk thoroughly. And if we combine the cyber risk with the interlinkages between the different players, the combination can only increase this potential for a very serious problem. As a result of what I just said, I think it should come without surprise that we will definitely need to further develop the existing prudential measures that tackle cyber risk, and also taking into account the systemic risk involved. This will have to include also macroprudential measures. Last but not least, on the challenges that were brought by new technology, it is, of course, the multitude of new players it brings to the offering of financial services to end users. We still have to assess whether such new players and services they provide can pose a direct risk to financial stability. We should also be concerned about whether these new players and traditional banks compete in a level playing field. Banking regulation and supervision don't often apply to big techs and fintechs, which consequently, compared to traditional banks, they face little regulatory scrutiny and the costs associated to that. At the same time, and in addition to their own data, the big techs and the fintechs, they may be able to access the client data that traditional banks have. So this combination of lower regulatory requirements together with access to more data can prove to be a significant competitive advantage, with the potential to disrupt traditional banks and the financial intermediation they provide. Going forward, and given the characteristics of these new players, cross-border coordination across policymakers will certainly be key, but it won't be enough. We will also need to involve not only financial supervisory authorities, but also competition and data protection authorities, to make sure that all the perspectives that might give rise to financial stabilities, they are addressed. And here, although this goes without saying, for the sake of clarity, I think it is important to stress that the role of regulation and supervision is not to protect banks. The goal is to ensure that financial services in general, and banking services in particular, they are properly provided to all economic agents that need such services. Or in other words, same services, same risks, same rules. Moving now to the fourth session we've had that was focused on green and sustainable finance, which I had the pleasure and honor to chair prior to this closing. Let me just add a few, as a summary, a few thoughts on the green and sustainable finance. We have heard many times that climate change brings about physical and transition risks. And in the case of transition risks, one that ranks very high derives from the climate-related policies, particularly if such policies they translate either into forcing firms to abruptly adjust their activities or into sudden reductions in the demand that are directed to some of them. If such abrupt changes occur, that may trigger large-scale defaults and bankruptcies that will end up affecting banks' balance sheets. Measuring this exposure of the financial system to these risks is key to understanding the effect of climate change on financial institutions. But the challenge to measure such exposure is huge, both as a consequence of the scarcity of climate-related data, as well as the lack of tailored methodologies to deal with this high uncertainty, with non-linear impacts, and with the long horizon of climate-related risks. This means that going forward, the financial regulators and supervisors, they must complete the work, not just on creating consistent and comparable climate-related disclosures, but also, as it was the case with cyber risk, on upgrading the financial stability and prudential framework to incorporate climate-related risks. But even if the regulatory and the prudential framework there requires time to adjust, when it comes to assessing the exposure of the financial system to climate risk, financial institutions have to take an active role. And it is essential that they develop their capacity to manage these risks. I've mentioned the challenge to regulators and supervisors, but we have to keep in mind that the driving seat and the steering wheel of climate change and the policies to tackle this is reserved to governments. But again, just before finishing, I wouldn't feel comfortable without an additional comment on this. It's not up to policymakers to pick winners and losers in this transformative path towards carbon neutrality. Policymakers, they have to provide credible and predictable flexibility so that we have the right context to allow economic agents to take their decisions, be it the short, the medium, or long-term ones. And with these words, I would like to conclude my messages and also bring this conference to an end. On behalf of the entire board of Banco de Portugal, I thank you once more for all those that participated and made this conference possible. And we look forward to see you all in 2023 for the next edition of the Financial Stability Conference. Goodbye, and thank you all.